Good morning, everyone. Thank you so much for joining us for yet another installment, you PPP enthusiasts. Today is Tuesday, June 9th. I'm here with Marina Parkin and Jackie Durham, my dutiful partners in practice, and I would like to say in crime, but no crimes here. There's Renee. We are going to talk to you today about the most recent changes to the CARES Act. At this point, it seems to be a bit willy-nilly. So I know for several weeks now, we have promised you we're going to be coming to you to give you the update. We're going to walk you through the loan forgiveness application. We're going to give you the step-by-step. And at this point, you probably think we're lying. We're not lying. We just can't seem to get our arms around rules because they continue to change yet again. Jackie is in continual and perpetual dismay. So if she seems disheartened, she is. She's put a lot of time and effort, all of us, but Jackie particularly has put a lot of time and effort into having her magnifying glass out, reading the actual legislation, not just the summaries. And like Marina says, the devil's in the details, and it's a big old devil this time. So without further ado, let me turn it over. I will continue to monitor the Q&A box. If you do have questions, continue to please put them there. It's a little bit easier to manage than in the chat bar. So, Jackie.
So this is a little outline of what we're going to be covering today. There's quite a bit to cover, and there's even some new information that has just come forward as recent as this morning, that via a statement that was issued by the Treasury Department, which actually conflicts with the verbiage in the act itself. But what fun would it be if we didn't have that going on by SBA and the Treasury Department as usual? So
what else would you be doing? What else would you be doing on a regular plain old Tuesday if it wasn't for managing the Treasury Department's overreach of their power?
Exactly. So we'll let Marina start with the extended covered period, because a lot of that will build into some of these other items. So Marina, I'll let you start.
Absolutely. So the extended covered period for the loan is probably the most popular change, and that's what everybody has seen since the news came out about this act being signed on June 5th. So the basic thing here is, as we knew, the loan covered period was 8 weeks. So it was 8 weeks from the day that you received the loan proceeds from the bank that you had to spend them appropriately. That period has now been extended for 24 weeks. Which is great for a lot of people, not so much for others. A lot of people have already undertaken steps to make sure that the funds were appropriately spent over an 8-week period. And we'll get into some of that discussion a little bit later. And now finding out that you have actually had more time to spend, and maybe you didn't need to increase salaries or give out bonuses or, put your spouse on payroll or something like that. You actually now have more time. I think that a lot of people who have taken those early steps are now probably thinking, that really, it doesn't really work for them very well. But there's a lot of other businesses who received the funds and they were not fully operational. And I think this is really where this change came from, was a lot of criticisms to say that those PPP funds were processed fairly quickly once your application was accepted. And once you received the money, a lot of businesses were still closed, or if they were open, they were not operating at capacity. So giving that longer time frame to spend the funds is definitely a benefit to those businesses who are now slowly starting back up. So the other thing that I did want to mention at this point is you can still choose to have an 8-week covered period. If you spend all the money appropriately after the 8 weeks, if you receive the loan before this legislation came to be. So if your loan originated before June 5th, you can still elect to have the 8-week covered period. If it's after, you are stuck with 24-week covered period. So even if you did spend all your money after 8 or 10 weeks, you have to wait till the covered loan period is over. And we'll get into a little bit later on, the due date of the application, which we still don't know, and how that affects with the extended period. But just know that now you've got 24 weeks to spend the money. So that's the main point here that I think everybody has been wondering about, because that's what made the news first.
Can you also address if that is 8 or 24, or can you make a 10 or 12? Are there interim steps? I'm getting that question a lot in the email.
No, there's no
It's gonna be
interim
one or the other.
steps. Yeah,
Yeah.
it's one or the other. So essentially, even if you got your loan earlier, you still have 24 weeks. If you feel like you already spend the money after 8 weeks, you can still choose for your covered loan period to be 8 weeks if you received it before June 5th, but you can choose it to be 10, 12, or 16 or
Gotcha.
anything in between.
And here's why, because this covered period is not just providing you with the amount of time to spend the forgivable expenses, but it also carries some restrictions about what you can do in terms of wages and employee headcount. So if you're a borrower and you're able to spend all of your proceeds during a 10-week period, that doesn't mean that now you're free from the other restrictions that come along with this covered period when it comes to your employee headcount and the wages. You are stuck with that 24-week period. All right.
Thank you.
So one of the items that came to our attention this morning because of that statement that was issued by the Treasury Department relates to this 5-year minimum maturity that everybody was so excited about. We all thought that, like the 24-week covered period, that would apply to all borrowers regardless of when they received their PPP loan proceeds. But apparently, according to the Treasury Department, and this is not consistent with what the Act says, but whatever, the 5-year minimum maturity is only available for those PPP loans issued after the new legislation went into place. So if you got your loan before that date, unfortunately, you're still for now stuck with the 2-year maturity unless an additional act or regulation is issued correcting this. Something I also want to mention is you'll see that the maturity is triggered, or the tolling of maturity is triggered by when a borrower actually applies for the loan forgiveness. So some people ask, okay, well, what if I just decide not to file for my loan forgiveness? Will that maturity date never start to toll? And the answer is no, even though the Act and the regulations don't specifically address this. What will likely happen is there's a cutoff time for that deferment period, which we'll get to in just a second. And I think that if you just fail to file for loan forgiveness, the maturity will start to toll once your deferment ends. So I'm going to dive right into that unless there's any questions on those.
One thing I had read this morning about that was, just to piggyback on what you've said, is that there is an opportunity for your bank to make an individual arrangement with you to extend from the 2 years to the 5 years. Just not a lot of incentive for them to do so. The bankers that I've chatted with have lamented that this program was really not a moneymaker for them, even though they did receive a discount point to issue the loans. With the 1% interest rate, it's barely covering their cost to borrow the money, their cost of the money to loan it to you. So extending that for 3 more years is not something that seems to be in the appetite of the banks at all.
Well, and to be honest with you, with the loan period extending to 24 weeks, I think there's going to be a lot more of the opportunity to get the full forgiveness and a lot less of the individuals that will actually have a loan leftover portion of it.
Right. So one of the other perks that came with this act is the extension of the deferral period, which previously was 6 months from the funding of the PPP loan. And the reason for this extension is it really, based on the other time periods involved here, we had initially an 8-week period to spend the funds. Then your lender has another 60 days to process your forgiveness application. And then SBA has another 90 days to determine whether or not they agree with the forgiveness. So clearly that's going to extend past the 6-month mark. So in order to relax that a little bit and make it more practical, they provided that the deferral on the payments of principal and interest will be deferred until either the forgiveness is remitted by SBA to the borrower's lender, or the SBA approves the forgiveness amount, or a date that falls 10 months after the expiration of the 24-week covered period. So it's going to be the earlier of one of those two. That's when payments are going to become due.
Well, and
it's interesting that they did read something. So they were like, oh yeah, this will outrun the now extended covered period. Maybe we should change that. So they did read some of it. That's refreshing.
The issue is we still don't have a due date for when the application is actually due. So this is what Jackie and I discussed this at a bit of a length yesterday to say, if you don't submit for forgiveness, 10 months from the end of your covered period, it becomes a loan. So 10 months from that point, you have to start making payments. But if you submit for forgiveness, all of those timeframes go, SBA getting it approved, bank getting it approved, etc. But what is that jump off date? Nobody still knows when the applications are due. So this is where it's going to be a little bit hard to say, okay, well, just hold on, in 10 months you will have a loan or not have a loan. We don't know what the 10 months really is going to originate. So it's, we're still staying tuned on that. And from what I understand from the banks, they're just in as much of, processing as we are, just trying to wrap their head around the rules and figure out what they're doing internally on their end to start accepting these applications.
And that's exactly, you're hitting the nail on the head. It's not even just the due date is the last day you can apply. That's the outside date. But we still have, I don't know about you guys, I haven't run into a bank yet that's willing to even accept them. Even if you are taking 8-week covered period, and even if your 8-week covered period is done, because you've got some people who got money right away, their covered period ran either last week or this week or whatever, they may be ready. They may have followed our advice and kept their journal and have their numbers ready to go, and there's nobody at the bank to take their application just yet. And we've been pushing, particularly before this started to spiral out of control, to submit your application early before the rules change again. And the additional rule changes may be having a negative implication upon you. So although we were pushing you, get it in early, right now there's nowhere to get it.
Right. So Marina, I think you were going to talk a little bit about the reductions of wages or full-time employees, because there's been some changes also that came down regarding that.
Yeah, this was a provision that was in place in the original act, and so let me go over and refresh you guys' memory on what it was. So essentially, if you cut employees, if you reduce the number of employees between February 15th and April 26th of 2020, you had an opportunity to reinstate your full-time equivalent count by June 30th in order not to get dinged on your loan forgiveness by having less of full-time equivalents than you did at the time of application. So again, you had until June 30th. That date has now been extended to December 31st. And so you have 6 extra months to reinstate your full-time equivalent count to be the same as the period that you elected to be based on the time when you applied. And there's a little bit of an alphabet soup on those dates as well. That will depend on each individual applicant. There is 2, and if you're seasonal, there's 3 choices on what the comparison period is. Essentially, it's several months from 2019, or it's the first 2 months of 2020, or it's any 12-week period between certain dates for seasonal employees. But essentially, and we went over that provision a few weeks ago when all this came out. So, your forgiveness was going to be reduced if you're essentially cut full-time equivalents. But if you put them back, you were not going to get dinged for that. So now you've got till December 31st to reinstate that count. Now, where the again, the criticism of that date comes from, and some of the stuff that I read over the weekend basically said that, well, the application, the earlier version of the application was asking us for how many employee count, what's the employee count that we had on June 30th. Does that mean we have to retain the same employee count on December 31st or through December 31st? So even if my loan period ends, let's say August, let's say September, October, am I still required to have the same full-time equivalent count all the way through December 31st? That's where a bit of a gray area comes in. So although it's a great extension of the date to have to fix the reduction in the full-time equivalents, it's still not clear as to whether you you have to maintain the same employee count through the end of the year. So I think we hopefully will get some guidance on that. So that's the first thing that happened. Anything here, Jackie or Joanne, before I move to the next section?
No, I think that's great.
Yep.
Okay. There's a couple of new rules, which again, as some things are given, some things are taken away. So one of the existing rules too in the original guidance, or even an instruction in the application, was that if you are trying to bring your people back, but they cannot come back, or you had to fire somebody, or somebody resigned, that if you have a documentation of that process, again, you're not going to get penalized for the reduction in full-time equivalents when your forgiveness amount is calculated. So we talked at length that's what that documentation is going to look like, and do you need to have letters, do you need to have emails, or whatnot. So that rule to me seems to be tightened a little bit, in that you still need to have the documentation that you are unable to bring the employees back. Or of course, if you had to fire somebody or somebody resigned, all of that has to be documented. However, what has been added to this rule, it seems to me, is that you still have to provide the documentation that you are unable to hire similarly qualified employees to fill the positions. So again, if you're trying to bring an employee back and they refuse to come back, and you have documentation that you ask them to come back and they cannot, in addition to that, you have to demonstrate that you tried to replace them with similarly qualified employees and you couldn't. To me, this is also, it's screaming gray area right here, because what is similarly qualified employee? If you are trying to replace, let's say, an office manager, or an admin assistant, or, you know, what qualifications do you need to demonstrate that you couldn't get? It's one thing if you're trying to replace somebody that has particular set of skills, like a professional or somebody with a degree or somebody with a set of specific skills, but what does, you know, similarly qualified employees mean? I have no idea. So at this point, again, I'm just going to advise to keep documentation as much as possible to indicate that if you did lose an employee who couldn't come back or quit, and that you maybe tried to hire for a similar position and you couldn't, maybe an ad out or something like that. I'm hoping to get more guidance on that, but that seems a little bit of a gray area there. The other choice you have to, again, not get dinged for reducing the full-time equivalent is if you are able to demonstrate that your business did not return to the same level of business activity as it was operating at or before February 15th. And that has to be because of the compliance with CDC or OSHA or any of the other governmental services or anything like that. So to me, this particular safe harbor piece would definitely apply to hospitality and medical offices that were forced to be closed. And when they were reopened, they're still being reopened at very slow pace. So 10, 25, 50% capacity and so on. So that will be easy to demonstrate, I think, for restaurants and hotels and any of the other hospitality. And of course, the medical offices who were forced to close for a period of time to comply with CDC. But I think other businesses that may try to demonstrate that they were unable to return to the same level of business, I am not quite sure what it's going to take for these other businesses that may not have been forced to close, but that were just down because of the type of business they had. And, you know, if they were, this is, again, guys, this is a safe harbor. So if you had to cut your employees because you were not able to return to the same level of service, you're not going to get penalized for reducing the full-time equivalents in the forgiveness calculation. So To me, once again, this is a lot of the gray area, because what does the same level of business activity means? If you're the restaurant, your capacity is down. If you're medical office, you can document that you were actually physically closed. But if you're just business that's suffering because you are the ancillary business to these types of businesses, do you have to show reduction in revenue? Do you have to show, what else do you have to demonstrate that the same level of business is not maintained yet? And that's why you have to cut employees. So this whole full-time equivalent replacement or documentation that you couldn't replace them, I think still needs a lot of work and a lot of interpretation to be done. But the key is just document. If you really had to let somebody go, and if you really couldn't replace them, and you were down and you were still not open, just keep documenting that. And I think that's going to go a long way in filling out your application when it's time for that. Joanne, have you read anything else on this particular issue?
No, I would mirror everything you've said. And in fact, you know, it's whether it's keeping copies of the governor's orders in terms of the phases of what can open. It doesn't have to be anything fancy. It can be public information. But you just need to make sure that you're keeping all that up and running. You know, it's that part's going to be real tough. One thing Chris Sensenig is chatting with us about, and I think you've addressed it all, but I want to say it out loud to make sure there's no distinctions here you want to draw. She said, does the FTE issue also relate to a drop in business such that you previously needed an FTE, but now you only need someone 5 hours a week? Would you think that the payroll records for the expected time periods would suffice to show the downturn? I think the payroll records will show that you dropped off in the payroll, but not necessarily that business dropped off. I think that's going to be more like sales or collections, depending on the nature of the business. So we have some businesses that are preloaded. So like realtors, for example, realtors were not able to show property as usual in all of March and April. But in April, they may have still had their closings because that was business they wrote in February, for example. So I don't think it's going to be, the guidance will be specified to, oh, it's income, or oh, it's sales, or, you know, because you don't know when the timing of that revenue will hit. It will be, you know, unlike a restaurant where the sale happens today, the revenue is today. There are lots of businesses where the life cycle of the sale are longer. And so it may be that you're not going to see the income hit until August for a business. And so those kind of things are going to be, I think, fact specific to the industries or to the particular businesses. And I think this is going to be the biggest challenge. Even once Jackie can go to bed and wake up 2 days in a row without busting out her magnifying glass again because there haven't been drastic changes, it's still going to take the banks and the SBA and the Treasury Department a minute to wrap their hands around whatever ultimately becomes the final-ish version of these regulations, and to apply to practical instances like this, just like happened in the application process. It was very easy to just spout out these rules, and they were like, whoa, wait a minute, what if you can't be open? You know, they were adamant for so long that they would not extend the 8-week testing period, and then, or the covered period. And then it was like, oh yeah, well, you legally are not allowed to be open, we have to do something. That's going to happen with this application process, but it's going to be a bigger disaster and have a bigger negative impact on the business communities if they don't get this right-ish out of the gate. So I think you're going to see a bigger time gap, a lot of questions. I'm getting a lot of email, people pushing, I want to get this done, I want to get an answer, what do I do? And I keep giving the proverbial shoulder shrug because there's nothing to say, and that's a hugely unpopular answer, particularly given our positions, being attorneys and CPAs, and worse, putting ourselves out there on these webinars saying, come to us for answers, and then I go, oh, I don't have any answers. I mean, it's comical because it's so absurd, but I do think that we've got months of this, not weeks of this coming ahead.
Absolutely, absolutely. And the thing is, you guys have to put this particular rule in perspective. This particular rule only relates if you had a reduction in full-time equivalent. So this is not yet, are you going to get your loan forgiven or not? This is to address one piece of the forgiveness qualification. So number one, if you did not reduce your full-time equivalents, or if you replaced people, this does not apply to you at all. You don't have to worry about proving that you were unable to return to the same level of business. This is only in an instant where, number one, you had to reduce your employees. Number two, you were unable to bring them back. And now you're looking for a reason to show why you weren't able to bring people back so that you do not get penalized for reduction in full-time equivalent. So this is like, you know, subsection of a subsection of a subsection here. So don't get stuck on this if this does not apply to your particular situation. I'm seeing a lot of the chats and questions from the realtors. If you're the realtor who's working by yourself, you don't have any other employees, this does not affect you. You have one full-time equivalent and you have one full-time equivalent at the beginning and at the end. So this is not about the forgiveness part. This is only if you cut full-time equivalent people during the period, as we discussed, and you were unable to replace them and bring people back, okay?
Thank you for that. I was just getting ready to go there. We're getting a lot of questions.
Yeah.
You know, and we again lied, if you will, and promised weeks ago we'd be having a realtor-specific forgiveness webinar, and that's still not coming because we still don't have the information that we need. It will be different, but again, as a realtor, remember that you are capped at the $15,385 forgiveness number, no matter what your loan amount was. Even if you accidentally over applied and you used gross commission income from before the rules changed, that's going to be the number you're at. The balance will be a loan. We don't know if it probably will be 2 years, but that we don't have mechanics yet for that. So at the appropriate time, we will reach out with respect to that.
Right. One more thing I would add to what you guys were just speaking about with this new safe harbor is, if our participants recall, we were talking about the regulations that came down recently, the most recent set actually a couple weeks ago, that provided certain requirements of if your employee wouldn't come back, what you have to show specifically in terms of documentation. One of the requirements was that you report that employee to the unemployment division. And I, for a good course, would recommend that you still do that, even though it's not restated specifically in the Act. I think that is something that in terms of your documentation, you probably want to still fall in line with that, because it is still part of the regulations. So there's going to be some overlap between the new legislation and the pre-existing regulations, and we're going to do our best to work around that, but to be safe, I would recommend doing that. Okay, so this previously said, it said forgiveness cliff before, and I deleted that because there apparently is a forgiveness cliff. Now, this is also kind of subject to interpretation. So the Department of Treasury issued a statement about a day ago that was contradicting some of what was provided in the Act, or what practitioners were interpreting from the language of this new Act. Now, what some practitioners are interpreting is a little bit different from how I interpret it, but there are going to be regulations coming down the pipe that are going to give us more clarification, and possibly even some additional amendments to the Act to make sure that this is not misunderstood. So under the old rule, or actually what I'll start with is, under the Act, there is a provision that provides that in order to receive any amount of forgiveness, you have to use at least 60% of the total loan proceeds on forgivable payroll expenses. So it appeared to create somewhat of a cliff. Well, under the prior regulations, there was a rule that SBA issued that said that no more than 25% of the total forgiveness can be attributable to these non-payroll costs. So it was another way of saying at least 75% of the total forgiveness has to be allocated to the payroll costs. Now, the Department of Treasury issued a statement clarifying that, hey, we weren't trying to impose a cliff, so to speak. What we were trying to do was sort of soften and loosen that allocation. So if you spend less than 60% of your total loan proceeds during the covered 8-week or 24-week period, you're not going to be eliminated from enjoying any forgiveness. It's just going to reduce the amount of forgiveness that you will otherwise qualify for. We're going to have a new 60-40 ratio in terms of the total amount of forgiveness is going to be capped at 60% based on the payroll costs, and then the balance will be capped at 40% for those permitted non-payroll costs. But what I do want to clarify is I do still think that under the Act, the legislation is trying to require that at least 60% of the total loan proceeds, whether they be spent during the covered period or outside of the covered period, 60% of the loan proceeds do still need to be spent on those payroll expenses. And we will get into this in more detail once the regulations come down that will offer more guidance, because now it's getting more confusing given what the Treasury issued a day ago.
And there may be completely unrelated government agencies that want to weigh on this too. So we'll wait.
This is definitely one of the rules that I actually did not expect the 75-25 split to change. To me, the 60-40, although I know it is helpful to a lot, I think gets away a little bit from the purpose of the loan, which was as a paycheck protection program. So the loan application was asking for payroll amount, and the loan was based on a formula based on the payroll amount. So when you are giving people the amount of the loan based on payroll, but you're telling them you can spend 40% on non-payroll costs, there's probably a bit of a hot water on, people cutting payroll and still having rent. So I understand, but I think it's those businesses that still had a lot of payroll were definitely using money for that properly.
Perfect. So I had this here to just sort of reiterate the fact that we previously had the restriction on the permitted use of the loan proceeds, which was that 75% or more had to be used for payroll, with the balance being used for the permitted non-payroll. And we do believe that the Act has updated this to loosen that to the 40-60 that we were just discussing before. And I think we also have some good news about the delay in payment of employer payroll taxes that Marina was going to touch on.
Before we jump on that, I think what I also wanted to add is that there has not been a change on what the non-payroll expenses are. I think, Jackie, you may have touched on that, but you're still only allowed to use them on rent, mortgage interest for the obligations prior to February 15th, and utilities for contracts that were in place before February 15th. So the uses of the funds non-payroll have not changed. And a lot of people were asking, oh, can I pay old credit card debts, or can I pay my marketing expenses, or can I pay stuff like that? That has not changed. So I don't expect that part to change. I think we are still really only stuck to these particular uses of funds for non-payroll portion. So I just wanted to highlight that. Payroll taxes. So this has also been a bit of an area which I'm glad they clarified it, because it was really confusing. So this came out at the very beginning, even before the PPP rules were, being cleaned up, is that you're allowed to defer the payment of employer portion of payroll tax, and specifically the Social Security. So employer portion of the Social Security tax, you were allowed to defer the payment of that. Basically any of those payroll taxes that were due between March 26th to December 31st, you were able to defer that over the next 2 years, with year one being next year, 2021, year two being 2022. So half of those payroll taxes would come due December 31st, 21, and the other 50% December 31st, 22. Now, when that rule came out, and then PPP started taking shape, they came out and said, listen, if you're going to get the loan forgiven and you're paying payroll costs with the loan, you should not also enjoy the benefit of deferring payroll tax on the payroll that you're using PPP funds to pay. So until you get your loan forgiven, you can defer the taxes. Once your loan is forgiven, you can no longer defer those payroll taxes. It was very unclear because you didn't know which payroll runs you could actually defer the payroll taxes on if you were under the PPP period. Is it when I'm paying my people? Is it after I receive my forgiveness notification? When is it? So all of that was very, very just gray and didn't make much sense. So what this act clarified, and I'm glad that they did, is that whether you are under PPP or not, if you have no PPP, every single employer has the option to defer the employer portion of Social Security tax for the next 2 years. So that is definitely a big win, and I believe that is going to be done on the payroll tax returns for the quarterly payroll returns. So I'm sure those with payroll service, that's where they're going to see the election to defer. I think there's some additional forms to do so. So just definitely make sure as you're getting close to running payroll. I know the second quarter is just around the corner, and those payroll reports are going to be due sometime in July, that you take advantage of the employer tax deferment if you need to, because remember, it's a deferment, it's not forgiveness. So if you don't pay them now, you're going to pay half of them by the end of next year, half of them by the end of the following year. So I think that if you are an employer, forget about PPP. If you're an employer that still has pretty good cash flow, I think my recommendation is just to pay your payroll tax as due. And unless you really could use that extra cash right now, then you can elect to defer. But anytime you defer anything, and we see this with all sorts of tax provision, when there is a deferral, when that deferral period comes, it's always a big shock. Always. Oh, I didn't realize. Oh, it's already now. Oh, it's already here. Yes, it is. So if you're not struggling, please pay the payroll taxes. but definitely know that
or sign here reminder card, like, you asked me to take the election and I told you not to. Sign here. So then when they forget, you hold it up, like, remember when you signed here that you were taking that deferral? Because it's true. It's like anything, you get it out of the way now, and then later you're like,
yeah,
it'll be third disaster by 2022.
Absolutely. Yeah, absolutely. And it's just a portion of your regular deposit that you're paying. It's going to be just the employer portion of the Social Security tax, which is a big deal. But I think that it's a great provision for everybody. And if you really are struggling and could use that extra cash right now, do it. Otherwise, I would recommend just go along, pay your payroll tax and move on, because again, with you deferring them, think about the tax deduction too. You can deduct payroll employer portion of the payroll tax. If you defer them, you won't be able to deduct them this year. So this, if you've got the cash flow to pay them and you want the deduction, please pay as you go. I think that's all I had on that one. That's a big one.
Right. Well, to round this out, the last point that I wanted to make is about the forgiveness application. We've touched on this throughout this webinar about the fact that there are some parts of the application that don't necessarily make sense. Certifying as to how many employees you're going to have as of December 31st is not going to make sense. So hopefully they'll tighten these up a little bit. And the Treasury Department did mention that they are going to be not only issuing regulations, offering additional guidance, but also updating the forgiveness application. So I know that some of you are very anxious to get your application in. I don't blame you. But if you are looking at the application and either your lender is not accepting it at this point, or you're finding it to be a little confusing, you may want to wait until this is updated to reflect some of the additional guidance that's come down through this legislation and that's going to come in through the regulations. And one of the other items that I'm hoping they remove is the fact that a borrower has to certify currently on the application that they've used the loan proceeds in full for the permitted uses. And if you have a borrower who has already gotten through their covered period, maybe hasn't used all of the loan proceeds just yet, but wants to go ahead and file their forgiveness application, how are they going to be able to certify something that hasn't happened yet? So just some of these items we think are not are not exactly clear, but we do expect some clarity to come down pretty soon here.
Yeah, the whole December 31st being the date for, to fix the reduction in your employees, and, some other dates in this. I am just fearful that a lot of these application due dates are going to fall right into next tax season. So if
I'll put the sign back up. I am off the cliff.
yes, we talk about this year being a never-ending tax season, but I have a feeling it's going to be never-ending several years of tax seasons. Which actually I did want to mention another issue. We did not put that on the slides. I was reading a little bit about it last night and chatted with Jackie about it. So let me just bring back one of the items that we covered a little while ago, which is the deductibility of the expenses that are paid with the PPP loan proceeds. So IRS issued a notice, and this is now, it seems like it's forever ago, it was probably just a few weeks. And that notice essentially said that if you are using PPP funds to pay these expenses, like the payroll and some of the other qualified expenses, and the PPP loan gets forgiven, you are not allowed to actually take a deduction for those expenses, because again, you are not out of pocket for paying them. They're paid with government money, so you shouldn't benefit from the deduction. There's been a lot of discussion about it back and forth to say this really was not the intent. The intent was to not really penalize the taxpayers for, not giving them the extra deduction. It was just really to give them this disaster relief. But as it stands right now, without any changes, we know that if you've got a PPP loan that is going to get forgiven, so essentially it's quote unquote free money, the expenses that are paid with that are not going to be allowed to be deducted. So one of the issues that came from this discussion is, if now we have this December 31st as potential end of the period for some businesses that will bring back full-time equivalents by then and, fix some of those safe harbor provisions, if they will not apply for the forgiveness until the following year, when they close their current calendar business year on December 31st, technically they still haven't received the loan forgiveness confirmation. Does that mean they can still deduct the payroll costs and some of these other rent costs, whatever you use the PPP loan proceeds on? So that's a question that's still definitely out, and I know we're going to be dealing with that next year at tax time. I am, going out on a limb here to say, no, if you know you've got a PPP loan and if you are fully anticipating that it's going to get forgiven because you met all of the all of the provisions under it, I think you are safe to assume that you're not going to get the deduction. And you probably shouldn't take it this year, because again, comes next year and the determination is made that the loan is forgiven, you may have to pick that back up in income if you took a deduction for the expenses this year. So there's going to be a lot of that crossover between one year to the next, but just know that that's an issue we're looking at closely, and we'll just have to work on with your tax return depending on when your application is due, when your forgiveness was determined, to make sure that IRS didn't issue any of the other rules about that. So just putting it out there that the amount of time it's going to prepare everybody's tax returns next year is going to increase. The attention on our end is going to increase as well, so definitely expect that to happen. That I wanted to bring that up. I was talking to Jackie about it last night, the deductibility, and Jackie was already off the cliff, so it was we just decided to bring it up to you guys just to kind of refresh the memory on this potential issue, and to let you know we'll definitely be watching that, but it's funky with the dates as they stand right now.
It's a creative approach, but I don't think it's going to work.
I agree. Yeah, I agree. And we mentioned the banks are not quite ready to accept the applications. I haven't heard anything from the banks. The most important thing is I anticipate the application itself will change to accommodate the new changes in this act. And of course, as more interpretations and regs are coming, I think the application is just going to keep changing and changing. So we'll just keep an eye on that. I always tell you guys, keep records of everything, keep all your payroll records, all of the payment of the other expenses, keep documentation on your employees, just have a file going with all of those items. And when we determine what really needs to be submitted versus kept, we'll definitely bring that to you. But this is not like a tax return where you keep all the documentation, and if you get audited, you have to provide the backup. There's a lot of backup that's going to have to go with the application. So there's going to be certain things you have to keep and have available, but there's going to be a lot of things you have to actually submit. So the better documentation you keep now, the better off you're going to be when it's going to be time to prepare this application.
Yeah, so not only will there be never-ending tax season, and we will have like no holiday because all this is going to pop up at the end of the year. The participants are going to have never-ending tax files. So if you thought you were keeping everything already, here you go. Watch out. Get a bigger folder. Get a bigger shoebox.
Yeah, absolutely. And from everything I'm reading, a lot of literature too that says that this is all SBA and all that stuff, but IRS is going to be a regulatory agency that's going to be watching the tax returns closely. And I think they're going to have they usually have their top 10 things that they watch for every year, like their hot items that they know people screw up on and they can catch you and, collect more tax. I think that when IRS starts looking at the 2020 and 2021 tax returns, a lot of this stuff is going to be a hot issue for them. So there's going to be a lot of scrutiny by IRS on your tax returns as to where this loan shows up, how the forgiveness is showing up, where's the payroll cost, are you taking the deduction where you shouldn't. So it's not necessarily, if you got by the SBA and your application was perfect, that doesn't mean IRS is not going to look at you from the tax return standpoint. So I think you just need to expect for everything to be scrutinized closely.
It's definitely not a year for TurboTax.
No TurboTax, please.
If anyone out there doesn't have a legit CPA at this point, this is when you need to sign up for one.
It's barely the year for LaCert with a professional.
Exactly. The professional software, I feel like every time I turn it on every day, there's a new update, and, they're trying to, get around some of the forms and everything and figure out how some of those updates, and there's always new stuff. So yes, even the professional software is trying to keep up, but never mind TurboTax.
Darling says it's never the year for TurboTax.
Yes.
As we've been reading this stuff, it's funny because I do see frequently things come up that say, you think something is easy until you start to learn about it. So the second that you say, oh, that's not that hard, it's like, that shows you don't know anything about it. So, because once you dive into anything from, knitting to taxes, you see like, oh, that's not as easy as it looks. I got busted recently on golf. I thought it certainly looks easier than it is.
I think it's the same reason why you guys don't like it when I start coming to you with S Corp and partnership questions.
Yes.
It just opens up a giant, ugly box.
Yep.
With a magnifying glass. Nobody wants to see that up close.
Oh my gosh.
Yep.
Oh, perfect.
Any other questions, Joanne, that you've been seeing that we maybe should head back now?
We have a question specific to asset sales and how the debt forgiveness component of this will be affected by the sale of a business. But I think that's beyond the scope of what we're doing here. So I've asked to speak to that person privately. So that's a good, a novel concept, something I didn't think to throw into this bag of frivolity, but but real life continues to happen, and so if there are business sales, that'll be another wrinkle to keep track of. So once again, everybody, thank you so much for your time. If you have questions, you're welcome to submit them to us via email. We will continue to address them on these webinars. We will also, as you saw last week, we did a webinar on refinancing. We're going to start to open up the webinars to additional topics. Not just COVID. We're going to keep this format. So if you have topics you'd like to hear about, please let us know, drop us an email, and we want to make sure that we're providing the information that you are in need of. We will, as always, continue here. We'll keep you posted. This email will go out after the conclusion of the webinar. You'll receive the recording. They'll be available on Facebook, on our YouTube channel, on our websites. So you'll have access to that automatically. Feel free to share it with your friends. I will say thank you to everybody. I've gotten a lot of handwritten notes, a lot of emails, a lot of phone calls of people saying, you guys are awesome. Thanks for doing this. We're happy to help. We hope it's helpful. We feel like this is the part that we can contribute to the community, and we really feel strongly about sharing the information as we learn it. We know it's frustrating, and it's dense information. So kudos to our groupies that are on here all the time, following us and listening to this. As I always say, I have the worst topics, and yet people continue to come. So we really do appreciate that. And there are days when we're kind of dragging in the mud a little bit, and you open the email or you open the card and you see that, and it really does, it does boost you for the day and gets out the magnifying glass again. So thanks everybody. Have a great day. We'll see you on Thursday.